Hello and welcome to today's webinar, A Better Way to Get Commodity Market Exposure. This is a complimentary Index Universe webinar courtesy of Bloomberg Indexes. I'm Rebecca Hampson, European Editor of Index Universe, a leading authority on news and analysis in the ETF market. We're also the company behind Inside ETFs Europe and Inside ETFs, the largest ETF conferences globally. Before we get started, you should all be able to see a box at the bottom right of your screens where you will be able to ask questions at any time during the webinar. We will also have a designated time slot at the end of all three presentations for questions and answers. The slides and webinar will also be available to everyone 24 to 48 hours after we finish. Joining me today are Alan Campbell of Bloomberg Indexes, John Kowalik of Securities, and Roland Morris from VanEck Global. Alan Campbell is product manager at Bloomberg Indexes, and this year he's been tasked with growing the commodity index and currency side of the business. John Kowalik is executive director at UBS Investment Bank in the Commodities Investor Group. He specializes in developing commodity investment solutions for clients, including institutional advisors and commodity-focused asset managers. Roland Morris is Managing Director of Commodity Strategies at VanEck Global, the US-based investment house. He focuses on macro strategies, commodities trading, and VanEck's long-only strategies and alternative developments. Bloomberg Indexes is a relative newcomer to the world of indexing, specifically focusing on the fixed income, currency, and commodity asset classes. And we will hear more about that today with more on the constant maturity commodity index and also products from UBS and VanEck. There's well over $100 billion invested in futures-based commodity strategies, but maintaining exposure to commodities can be complex and costly, be it controlling contango, picking the right commodities, or selecting the right point of entry in a commodities curve. And this has prompted market participants to focus on optimizing the commodity investment experience. The UBS Bloomberg Constant Maturity Commodity Index is in this category. So with no further ado, I'd like to hand over to Alan Campbell, who will be able to further explain the effects of the CMCI.
Good afternoon, everybody. I hope all of you can hear me okay. I guess hearing me is one thing and understanding this accent is another. I'm going to spend 10 minutes discussing the challenges that investors face with traditional commodity indexes. But first up, some news, a big announcement in the investable index space. In the last few months, we launched the Bloomberg Index business. Let me tell you what the Bloomberg Index business is. It's a new business which focuses on developing and licensing fixed income, currency, and commodity indexes as the basis of investment products. Issuers of ETFs and mutual funds will be licensing our indexes to create investable products. We have a long-standing partnership with UBS in the commodity index space, which we'll talk about in great detail over the course of this webinar, but you may be interested to hear that just a couple of months back in June, Bloomberg launched the first truly independent, truly global fixed income index family. Independence matters, especially when it comes to these less traded markets, and we brought a new concept to the bond markets, independent benchmarks. So Bloomberg's family of bond indexes is built upon Bloomberg's legacy of bringing transparency to the bond market. Data is fully available on our website, bloomberg.com, bloombergindexes.com, and the Bloomberg professional customers have complete access to our index data within our broad suite of portfolio analytics. So together with some ETF partners, we'll be bringing several ETFs to market in the coming months in the FX space and the smarter beta fixed income space, so do look out for that. You can also check out the bloombergindexes.com site for more information. In the commodity futures market, there are multiple entry points because of the term structure of futures contracts. The question arises, do you make a bet and pick a point on the curve or seek to diversify your time exposure? Investable commodity indexes began in 1991 with the creation of S&P GSCI, and the Dow Jones UBS Commodity Index was launched in 1998. These older commodity indexes, as I mentioned, have several characteristics that are often cited as a concern for investors. Diversification in its many forms is an issue, as an often quoted concern is that component weightings in indexes like GSCI and DJUBS are too concentrated. In the case of GSCI, the energy sector alone approaches 70% of the index, and in DJUBS, the majority of components have 4% or less weighting. That said, chief amongst the concerns for these traditional first-generation indexes is the lack of time diversification. What does that mean? So for a given commodity, these indexes invest in only a single futures contract that is close to expiration. As a result, these indexes need to frequently roll their position forward to the next contract, and that can lead to significant trading costs for index replication with commodity futures. From an investor standpoint, the front of the curve may not be the most desirable area to hold a long futures position. So in January of 2007, UBS and Bloomberg joined forces to introduce a novel concept in commodities indexing to solve many investor concerns with these traditional indexes. The UBS Bloomberg CMCI takes an approach which can be termed a cross-the-curve strategy. A constant weighting scheme is applied across commodities. So there is a fixed weight in corn, a fixed weight in coffee, but this position is spread across several contract expirations. So for example, the CMCI satisfies its target weight for WTI crude by spreading out the holdings across multiple tenors, like the 3-month, 6-month, 1-year, 2-year and 3-year contracts. The rising interest from investors for commodities over the last decade has prompted remarkable financial engineering in the index space. Different indexes have different components, different weights and other rules which render them very different from one another in terms of historical and projected performance. Investors need to carefully examine these differences before acquiring the appropriate exposure. So let's examine what investors are currently faced with. Commodity indexes that pick a point in the curve, be them passive or active, and often less volatile indexes that are diversified across the term structure. Here's a list of products that give investors exposure to the UBS Bloomberg CMCI. There's exchange-traded certificates that are listed in Switzerland and London in many currencies at the composite index level. If an investor wants to be more targeted, there are more narrow products such as a single futures contracts and also commodity sectors. In addition, there's a US-listed mutual fund from VanEck called the CM Commodity Index Fund. I will now hand it over, but please do check out BloombergIndexes.com for more information on Bloomberg's full suite of index capabilities in the fixed income, currency, and of course commodity indexes. Rebecca?
Alan, thanks very much. I think we will now hand over to Roland, who will be able to expand a bit more on our X business here.
Thank you, Alan and Rebecca. I'm going to cover a couple of things about this index and VanEck. I'm going to provide an overview of commodities as an investment and why CMCI. VanEck's been in the commodities business since the mid-1960s with our original gold miners fund, the International Gold Miners Fund. In the 1990s, we branched out into more broad commodity exposure with our hard assets products. And after 2000, we branched out into the ETF space with our products like GDX, the Gold Miners ETF. When we looked at commodities and we looked at providing an exposure to commodities, we looked at CMCI and many other products, but there were several things that we liked about CMCI, which I'll run through. But first, commodities is an investment. VanEck never really believed in the so-called super cycle, so we don't believe it has ended either. In general terms, we feel that the commodities are growing. The demand for commodities will continue to grow broadly, mostly because of emerging market growth. Emerging market countries now represent 50% of global GDP. As they develop and their rising standards of living develop, these economies will demand a higher per capita commodities use. And more generally, commodities are getting harder to find. We're not running out of commodities, but we're running out of cheap, easily accessible commodities. A commodity index product like this can provide exposure to commodities, which could capitalize on global consumption and demand trends, mostly driven by, as I said, emerging market growth. Again, if we get into an inflationary environment, commodities should provide a hedge against inflation as well. In particular, this index we felt also provided exposure to stronger growth trends, and I'll get into that with the allocation amongst commodities. Obviously, there's some risks to any of this. At the moment, it's unclear whether QE policies will lead to stronger growth or inflation. Let me just, sorry. Okay. Now, why the UBS product, UBS Bloomberg product, constant maturity? When we looked at this, there's essentially three drivers of returns in commodity index products. You've got the commodities themselves, you've got roll yield, and then you've got return on collateral. This product, we felt, in really quite elegant way, isolates the commodity exposure. The constant maturity approach, which we'll discuss in more detail, will eliminate, to the extent possible within the market, roll yield, positive or negative. And over the last recent experience in commodities, we have had a negative roll yield in most commodities, or contango. And the product does not take risk with collateral. I think that's another important aspect. It invests in T-bills. So one problem with taking risk with collateral is precisely when growth accelerates and demand for commodities grows and we get into an inflationary environment, risk with collateral can cause some negative experiences. But this index, in our opinion, isolated the commodity exposure extremely well. The constant maturity approach also is important in the sense that it picks and John will get into the actual details of how the engine picks this exposure, but it picks the exposure and it rolls essentially on a daily basis. So you maintain the exact exposure from both the commodity exposure and the curve. It then rebalances on a monthly basis, and this is important, and I think it's another elegant part of the design. If there's been a huge move in 1 month, it will rebalance that commodity. So if a commodity was up 80% in a month, it will reduce that exposure and add to the other commodities as it rebalances. Additionally, if there's an extreme move in the curve, it will do the same. One other thing about commodities, I've been following commodities for over 30 years, and obviously they're difficult, volatile instruments and hard to predict, but possibly the hardest thing to predict, in my opinion, is the shape of the curve. And this constant maturity approach removes that problem. Now, weightings. If you look at, John again will explain how the engine picks these weightings as we move on. But the weighting, in our opinion, is important. It's a much more diversified approach as well. And you can see from these weightings here that you have 35% energy, 32% agricultural, which includes livestock. You have 26% base metals, and I'll point out later that's quite a bit different than other indexes, and then 6% in precious metals. John will explain the details, but it does pick these exposures based on developed market GDP. And that eventually is what we feel emerging market exposure or consumption will look like as well. Now, this slide shows some of the, over this period that's covered, what negative roll produced for some of the other indexes and how it was minimized in the CMCI index. And this is for the period January 1st, 07 through September of this year. And you can see we've had quite a bit of negative roll or contango in the markets during this period. Now here, this is an important slide because if you look at some of the other indexes that are out there, this index, if you'll notice, has pretty large exposure to industrial metals. We also felt this was important when we looked at this index because it's an important driver, or demand for industrial metals is an important growth indicator. So we felt that in addition to providing some protection from inflation, this index in particular would provide some good exposure to global growth as well. And with that, I'm going to turn it back to Rebecca and then over to John. Thank you.
Roland, thanks so much. That was very informative. I think I will now hand over to John, who will be able to expand more on UBS and what they're doing and the products.
For the for the great recommendation there. I'd like to go into some of the detail in the construction of the CMCI and highlight really its differentiable characteristics relative to other index families. Of course, UBS is very well involved in the commodities index business, and we're one of the sponsors of a variety of index. The CMCI, of course, is our premier product that we partner up with Bloomberg on. And what you'll notice on this slide here is an overuse of the word diversified, but the CMCI is diversified along 3 vectors, and I just want to emphasize this and carry it forth. It's diversified across sectors and components, as Roland has mentioned, as you'll see as we move on. The diversification is quite extent, and really on any statistical measure of diversification, you'll find that it's not necessarily the number of components in the index that makes it diversified, but it's really the weights combined with the numbers of components that makes it diversified. And quantitatively and in independent measures, you'll find the CMCI to be more diversified than any index out there that I've been able to find. You're welcome to do your homework and see if there is one. Not only are we diversified across the individual components, as Roland mentioned, we are diversified across the price structure of the individual commodity components. And the diversification, depending on the liquidity of the market, as you'll see, can go up to, for an individual component, up to 6 points along the curve, 3-month, 6-month, 1-year, 2-year, and 3-year points along the curve. And then each of those points along the curve are weighted amounts of 2 contracts. So really for large liquid commodities, you'd have up to would be about 10 futures contracts worth of exposure. The rolling process for those futures contracts, it is a daily rolling process in order to keep the weights for each individual point on the curve equal, the maturity equal and constant, and that daily weighting process involves moving small amounts from one contract ahead of the price point on the curve to the other contract on the point just past the point on the curve. And this daily rolling process, what it really does is avoid getting exposure to any idiosyncratic curve risk. If part of the curve moves particularly out of line, either favorably or unfavorably, that effect on returns is generally minimized by the daily rolling process. You don't get caught because of some sudden market move. Okay, once again, to reiterate some of these topics covered before, there's minimum exposure to the front futures contract, unlike the main original commodity indices, the GSCI and the Dow Jones UBS, which typically have exposure in the first or second front contract. Since the point of the CMCI that's furthest up toward the front is a 3-month part of the curve, generally, especially for commodities that have monthly contracts exposure, you will have some exposure in the second contract out, and then right before the 3 months out, and then some exposure slightly after that, and that's only for a small portion of any given commodity's risk exposure. Generally, for a lot of commodities, you get a more attractive risk and return profile by having exposure further out the curve, and you strategically and structurally have reduced exposure to negative roll yield in the markets, and those are typically markets in contango and typically occurs more in the front end of the curve. As Roland mentioned, the monthly rebalance to the target rates reduces concentration risk. If a commodity has a high price spike, that commodity is sold off at the end of the month for the monthly rebalance to the target rates. And of course, this adds returns in volatile mean reverting markets, which occur in commodities quite often. The daily rolling process, as I mentioned, reduces the effect of one market's day's market action, and also reduces the risk of the index leaving activity in the market. I mean, there are from time to time during the rolling process for the Dow Jones UBS and the GSCI, occasionally distortions appear in the market, or at least it looks like distortions appear. And that is not an issue with the CMCI. Regarding the design of the CMCI, the weighting engine combines economic weights and liquidity weights on a sector level. And then on the component level within the sectors, it's the dollar value of global consumption combined with the liquidity, which is a combination of open interest and market value. And I think really one of the design characteristics that you don't find in other commodity indices is the sector weight distribution. And this creates a more uniform distribution and results in the diversification characteristics of the index. Of course, there are certain caps and floors to ensure that no particular commodity gets particularly concentrated, nor is any particular commodity exposure so small that it's really present only in name. So, so any commodity in there has some impact on the return. This is a very complicated chart here, but basically the main points here is to look at on the right-hand side of the chart, the weights of the constant maturities per commodity to see where the distribution of exposure is for each commodity. And you can see for the energy and the metals, for the most part, exposure goes out 5 points to the 3-year point on the curve. I don't think there's any other index out there that goes out that far, perhaps 1 or 2. But really, to have the exposure starting at 3 months and going out to the 3-year part, that's a pretty unique aspect of the CMCI. Once again, the weights in energy and industrial metals, you can see, are slightly over 60%, which are really more economically focused commodities. Precious metals also are in there as well, but not to a great extent. So once again, we have a high concentration to economically sensitive commodities, which really makes it a great attribute to have in a diversified portfolio. The agriculture exposure is still, of course, quite significant. But once again, I do want to point out with agriculture where a lot of negative roll yield exists, the CMCI, of course, the first point of exposure is a 3-month point of the curve. And so the negative roll yield associated with agriculture is generally minimized. In terms of performance, what has this all led to in the past? I'm going to look at the various sectors and returns, and you'll see that the CMCI for agriculture over the period shown here has been the top performing sector for the CMCI as compared to the other commodity indices by a significant degree. And this is primarily probably because of the term structure exposure of the index relative to other indices out there. Energy, well, not necessarily the top performer here. Well, certainly a great, one of the upper performers of the various indices out there in the energy sector. Of course, the Dow Jones UBS down below having a long-term negative return there is probably a component because of the natural gas exposure in the Dow Jones UBS, which is higher than most other indices. Industrial metals, CMCI once again, top performer, albeit negative over the time period shown. And over the long term, if you look at the lower right-hand chart here, the annualized roll and collateral performance versus other indices, the CMCI has very minimum negative roll yield compared to the other indices, and this has resulted in long-term performance on a relative basis. Once again, if you compare the CMCI to second-generation indices, which are further out the curve, the return has been higher than the Deutsche Bank, the JP Morgan, the Merrill Lynch, and the Credit Suisse Commodity Benchmark Index. So even over the long term of similar indices that have exposure to different points of the curve, the CMCI has been a great performer. I would say part of that outperformance has been due to the mix of commodities in the CMCI. And that really covers it for me. Be happy to take any questions if anybody has any. Thank you very much. Rebecca, off to you.
John, thanks so much. It was really interesting. Just to sort of get us going a bit more, given what you've talked about, I wonder if you could expand a bit more on the products, the ETCs that are tracking the index, and how sort of where the costs lie with them, how they're working, what the trading's like, and how well they're being received.
Well, we have. I'm not going to get into specific costs, but we have an extensive suite of products for the European markets and CMCI and the exchange-traded certificate product, not only in a variety of currencies, but also not only the composite index, we have the sectors, we have individual commodities, and certainly to a limited extent we have certain parts of the curve too, so you can buy just one vertical slice over time. We have billions of dollars of exposure of this globally. It's been a very popular product in Europe and across the European area, and of course with Van Eck leading the charge here in the U.S., we hope that's been one of the bright lights and growing products here in the U.S. across all commodity space. We hope to continue and expand upon that in the future because the CMCI is really, as Van Eck has been the domestically in the U.S. recognized expert in commodity space in terms of being equity managers and other markets as well related to commodities. They of course had their choice of whatever index they wanted to choose for licensing for their fund. They chose the CMCI. So it really speaks well of the index that commodity experts have chosen here in the States, have chosen the CMCI to be their flagship index for their index fund. And like I say, in terms of growth, that's been one of the shining stars here in the U.S. market in terms of adding assets relative to other assets out there.
That's really interesting. Actually, Roland, I wanted to come back to you. As you say, the Van Eck are based in the U.S., and this is where they are recognized as the commodity honcho. I wondered if there were any plans for Europe, and if so, whether you would come and use this index, you put products on this index throughout Europe.
Yes, well, thank you. This is actually our sort of first entry into the commodity-only investment arena, and we do expect to expand on it, and we expect to provide some European products as well. We have another product coming out at the beginning of next year, but CMCI we hope to have some new products as well. It's the one thing that John did mention. Thank you, John, for talking about this. We did spend some time looking at indexes, and I do think the design of this index has some very elegant solutions to it. And so we're excited about it. It is starting to grow. We think it is a better way to get exposure to commodities, and we should hopefully have some new products that will be European targeted as well. We have in our traditional hard asset space, we have some European products, but this one we haven't moved to Europe yet.
Okay, thank you very much for that. The other thing I wanted to, I'm going to ask is about the weightings. There is only 6% in precious metals, and given the problems with inflation, the Fed announcing that the tapering policy might come in, would you not prefer this? Would it not make sense to have precious metals as a bigger portion to protect against this? And I suppose, John, this is really directed at you.
Sure. I'll give a shot at the answer. What I find, I've dealt with a lot of institutions over my career, and as far as gold and precious metals go in particular, it's quite often that is seen as gold is not what you call a standard commodity. It's mined, it's produced, it's generally not consumed. It could be considered a currency, it could be considered a tail risk. Oftentimes investors look at that as a separate allocation away from their commodity basket, which is generally considered an inflation hedge and a diversification risk. I mean, you can see, the gold price has not done particularly well. So if as an investor, and there are a lot of products out there that are gold oriented for gold investors. So, I like the fact that the CMCI does not have a significant amount of gold. 6% is not a trivial amount, or precious metals at 6% is not a trivial amount. But on the other hand, given that gold can be seen as its own separate asset class, having a significant portion in your commodities or a lot, is really not a role. I'd much rather be able to add to gold in addition to my commodity exposure as opposed to try to figure out a way to take it out if I didn't like it within my commodities exposure. So in terms of commodities that are really supply and demand oriented, prices dependent on overall economic growth, I think you get more of those in the CMCI. Gold is not exactly one of those type of products. So, like I say, to be able to add it to as opposed to subtract it from, I think the CMCI actually is better positioned in that regard.
I actually would agree with John on that. And we have some great gold-only products as well. The investor over the last decade has had numerous ways to invest in gold directly, whether it's GLD or our equity products, GDX, and our mutual fund gold miners products. And so I would agree with John on that. This index really is, I think, well tailored to participate in global growth. And ultimately, if we did have an inflationary environment, it should perform well in that environment as well.
That's great. Thanks for that, Roland. Another question is, it's clear that the index is performing well against your S&P, GSCI, and the Dow Jones. But how is it performing against other comparative so-called second-generation commodity indexes?
Well, we do have a slide here, which let's see if I can find it quickly. There, if you look at this slide here, this is comparing against other secondary commodity indices. Do we have a slide up here that shows CMCI against the Deutsche Bank, JP Morgan, MLCX?
Yes.
Okay, great. So as you can see, over the long term, the CMCI has definitely outperformed relative to these indices. And I suggest if one wants to do their homework, and I'm not going to make many points regarding these other indices, the Credit Suisse Commodities benchmark is highly energy-oriented benchmark. I think energy is between 50 and 55%. I don't have the breakdown on the other competitive indices out there, but you can see that the CMCI has definitely over the long term had outperformance relative to the others. Plus, we have a product offering that is easy to access and out in all markets as well. So I'm not sure that one can access some of these in the variety of product forms that we have available. So, as far as I see it, better performance and better accessibility to market participants all are good positive attributes of the CMCI.
In terms of access to, just talking about the access there, I mean, when you say other indexes don't have access to them, how do you mean? I mean, is it the exchange-traded commodity that is enabling investors to get this access?
Well, that definitely is a way. That and fund managers, may use. I'm not sure that fund managers. A lot of fund managers use the CMCI as a benchmark. Obviously, Van Eck has chosen it as well, and in Europe there should be other fund managers using it as a benchmark. With these other more broker-specific indices, there may not be as wide of a distribution. It may not be as widely known. We partnered with Bloomberg so we could get global distribution, and that has worked out very well for us in terms of that.
Okay. The next question I have is, I mean, how do you determine the weightings of each commodity in the index?
Well, the weightings are a complex process. I still have the ball, and I know if I tried to describe it specifically, I would not get it exactly right. But the best way to look at it here, as I described, is determining a sector weighting first, which is based on GDP and inflation numbers for the sectors, as well as liquidity on an overall sector basis. And like I mentioned before, this is a unique process to the CMCI as far as I can tell. And then once the sector weightings are determined, which gives you a good diversified basket in terms of risk, then the component weightings within those baskets are broken down, both on consumption and on open interest and market value. So there are a bunch of different factors that all come into play to determine both the sector and the individual components, and which does lead to a fully diversified basket. And as I mentioned, one of the most diversified baskets out there. And when it comes to diversification, investors ought to make sure they're not confused by, more is not necessarily better. If you have 10 components out of your 40 that have percentages in the under 0.5%, those are effectively don't really bring anything to the table in terms of diversified returns. And that really is not, it's not a simple matter of more equals more diversification. It's a mathematical concept. It's fairly easy to calculate, and the CMCI is the large, has the greatest amount of diversification of any index I've been able to see in my 15 years of dealing with commodity indices.
That's great, thank you. The next question I have is, when is the best time for investors to use this, or is this something that you expect to see in general use in portfolios? And I suppose this is probably to both John and Roland. I mean, if we start with you, John, because I've got you on the line, and then Roland can maybe chip in at the end.
Well, sure. There's been a number of independent studies and wisdom out there. Commodities basically are an inflation hedge and portfolio diversifier. It's from time to time it's easy to time a market, but in general there should be a core position of commodities because it's the unanticipated price rises that can really hurt a portfolio if they're not hedged properly. And they're not, they don't have any hedges for inflation risk. It's the price rises that one can't anticipate that really, produce the positive returns in commodities. On the other hand, tactically speaking, commodities are cyclical. As Roland will be, I'm sure, able to testify, they're a cyclical business. And, from time to time, allocations should possibly be increased or decreased. Commodity prices do not go down to zero. There are natural, producer reactions to lower prices, which is to curtail supplies. So this cyclical nature can be taken of, by investors from time to time. But to drop them from a portfolio allocation entirely brings back the next question: is when do you put them back on? Obviously, has not been a great returning period for commodities recently, which in my mind only means to say that there's more room on the upside than the downside on a going forward basis. Roland, I don't know if you had anything to add there.
I would agree with John on several of those points. The thing that we felt was exciting about this index, because we tend to have clients looking to invest in the sector and hold for long periods of time. This was an index we felt that would be easier to hold because it does eliminate some of the negative roll characteristics which have been dominant in the market over the last decade. And so this enables, in our opinion, investors to hold a longer-term holding and exposure to commodities. And really, I can't say enough about the way this engine picks its exposure and its maturity exposure and keeps it constant. I think it really provides an excellent isolated exposure and one that you can hold for longer periods of time. And as John mentioned, it is the surprise growth or inflation where you need that commodity exposure, because if we get into a strong inflationary or growth situation globally, you're going to have some negative returns and some other exposures that you have in a portfolio.
That's very interesting. I have another question here that says, are the indices listed the only three competitors to CMCI? I think there were 3 indices listed on page, I can't remember which.
Well, there's one page here. These are first generation indices. The GSCI, the Dow Jones UBS, the Ritchie. There's also the Credit Suisse Commodities Benchmark, which is on the following page, the Deutsche Bank Liquid Commodities Index, and then the JP Morgan and Merrill Lynch products. I'm not sure if there is a readily available in fund format. I know there are some funds against the Credit Suisse. I think the Deutsche Bank product, there might be a Deutsche Bank product against that. Definitely the GSCI and Dow Jones UBS, there's product out there, and probably the Rogers Commodities Index as well. There are other commodity indices out there in various forms, without a doubt, of varying degrees of success. And of course, there are a lot of ETFs out there as well, focusing on all sorts of corners of the commodity markets, including, of course, gold.
Yeah, yeah. The one extra question I have is, are you able to expand on the monthly rebalancing and why is it in this time frame? Is this just because of the future roll and the way they roll forward?
Actually, the index itself, the weights are calculated every 6 months, and unfortunately, I don't have insight. I wasn't here at the development of the index as to why it rebalances monthly, but it generally leads to more stable weights over time. I think it doesn't necessarily make sense to rebalance any more frequently like that, but there's definitely academic studies have shown that rebalancing in mean reverting markets definitely adds to return over time. But
this index rebalances quite a bit more than other indexes, and if you think about it, in a 1 month period, you could have a sharp move in a commodity up or down, and it will re-weight to the target weighting monthly, and I think that's, as John mentioned, mean reverting. It's a very important aspect. Additionally, it does it across the curve as well. So if you have a very sharp weather-related move, for instance, in grains, it will rebalance away from the part of the curve that moved dramatically, and that it reduces volatility and it gets it back to its target weighting, which I think is another sort of elegant solution, in my opinion, to the approach.
I think, to add on to that, I think those are good points. If you look at, let's say, the Dow Jones UBS, which of course I'm intimately familiar with, if you look at natural gas, for instance, that's upwards of 13% of the index now, and of course the reweighting, which occurs on an annual basis and will be in January, that will end up being a sharp reduction in natural gas over January, and that's a fairly large and concentrated position that will be rebalanced basically once a year. So your index may morph from one thing to the other if a large position has a large move and then doesn't rebalance frequently. So having a frequent rebalance gives you reasonable assurance of pretty much knowing what you own at any given point in time.
Reverting back to that feature, is that something that's very unique to this index, the regularity of this rebalancing? And if so, why are no other indexes, would you say, why have they not done it?
Well, one reason why you wouldn't want to do it, because there's an awful lot of work to do it. I mean, if you look at the moving parts in the CMCI, it has an awful lot of movement going on. You may have up to 10 contracts per commodity. There are more commodities than the GSCI or of significance or the Dow Jones UBS. Is really quite a number out there, and there's a lot that's going on. The other indices were first generation indices. They were basically simpler, and we've have a more advanced index that was developed later and could, with greater understanding of commodity market behavior and index behavior. So as to why the GSCI basically just reweights, and the Dow Jones UBS reweights once a year, I couldn't speak to the others in gory detail about how frequently they reweight.
I would add that it's obvious the designers behind this index had no regard for the people trying to manage the exposure, because this is a complicated process, but that's what makes it, in my opinion, an elegant solution to gaining the exposure that isolates commodities and removes the roll risk. And I would point out it minimizes roll risk, both positive or negative, and it is, there could be a period, although I don't see it in the near term, where roll risk could become positive. But it is a very complicated process, and I think that's what makes it work well, in my opinion.
You bring up a good point there, Roland. I want to emphasize, in an upward sloping price curve, where roll return or roll risk is positive, having a position further out the curve does not necessarily mean you're not getting the benefit of the upward sloping price curve. So, in effect, and it's not obvious to most people, but if you have a lower price commodity further out the curve, and the curve term structure is is consistently same flat slope, upward sloping, you actually get more roll return further out the curve. Now, typically, that doesn't necessarily go all the way out to the 2-year part of the curve, but you can still earn positive roll return from positions further out the curve.
That's great. Thanks, guys. Another question I now have is, when it comes to explaining the index to investors, in terms of what we have here, what are the most difficult concepts to explain? Is it the roll? Is it the constant maturity?
Because of the complication, how complicated this index is, I think both those things are hard to explain. The constant maturity aspect of actually the contracts being rolled on a daily basis is unique, and that's easier to explain and sometimes than the maturity distribution. But one of the things I mentioned earlier is in commodities, I think predicting the shape of the curve is harder than actually predicting the move in a commodity. And it's because there's too many other variables that go into curves, whether it's weather, whether it's producer or consumption, hedging demands. There's just an awful lot of variables on the curve, and I think that's really what this index, the solution that it provides, is to remove much of that risk.
I would say the hardest thing to describe, and I can't say I do it perfectly, because to do it perfectly I'd say is almost impossible, is the weighting process. So what I try to do is make it simple and understand the components that go in. But obviously if you break down that page where you have all of the factors that go in, that's a lot of data to collect, collate, and assimilate. And we have a quant team that does it very well. But to actually explain all the moving parts, and if one really, it's not a simple, well, we just take global production and weight it by dollar value of global production. That's very easy to explain if that was our weighting engine. But ours for the CMCI takes a number of different data series on a number of different factors and combines them together very complexly. So I try not to claim to be explaining it in detail, because I do not want to explain something incorrectly.
Well, my approach is to approach it exactly the way John does, and use this particular slide that he used today, because I've been through the document, and the complication behind this engine is immense. And if you notice, at the two different levels, it actually weights liquidity differently. So at the first level, 2/3 of the decision is based on the GDP consumption weightings, and then at the next level, 2/3 of the decision is the liquidity of the instruments. So it is complicated, but I think it ultimately ends up with, as I said earlier, an elegant solution to the problem of roll risk.
That's great, thanks. I have a last question, and I'm not sure whether this is best directed towards maybe Alan or John or any of you actually. But what was the thinking behind this index? Why has this now been born? I understand that obviously Bloomberg has a sort of global platform from which to launch, but this is sort of, it appears to be trying to take commodity indexing to the next step. So where did this come from?
Well, I think, I'll take a stab at it. I was not here at UBS when it was developed. I do know the guy who was instrumental in developing the index. This is a way for roll yield, and matter of fact, the effects of negative roll yield, which I'll put in quotes, was a real concern to commodity investors in the mid-2000s. It really eroded. There's erosion of value to commodity investors by having this front-month contract exposure. And so the idea was developed as, how do we get commodity exposure without exposing to risk, at that front part of the curve, which was, for people who've been in commodity markets for a long period of time, such as I, it was just painful to observe that what was going on in the market. So this was a response to that. And, once you start once you start diversifying away certain kinds of risk, it's very easy, or it makes sense to diversify away from all forms of risk, particularly in commodities where there are, only so many out there. And, this at the time was seen as one of the best ways of getting that diversification of risk across all factors, not just, only concentration of certain commodities, but also, various forms of time risk and term structure risk.
I mean, when you think about the structure of the term structure in commodities, when it started to generate the negative roll yield, you're looking at a very frustrating situation where you're paying, 5, 6, 7% a year just to hold the instrument, and that, this is a solution to try to minimize that. And I think it was an obvious response to the structure of the markets. And remember, we started experiencing what I would call, supply shocks. Demand shocks, rather. So, you ended up with a period where the front months tend to be depressed by oversupplied markets. And that's the environment we've been in. If you went back to the late 70s, you had the opposite. You had supply shocks, you had high interest rates, and you had inflation. We're currently living in a period that may change, but it's frustrating to think about gaining exposure to a sector and recognizing you're going to pay away to gain that exposure, and this minimizes that. And I think it's an obvious response to those problems.
That's very interesting. I think I have one last question to ask before we have to wrap up. But whether this can be answered by you two, or I don't know whether this can, but what gaps are left to fill in the commodity indexing space? What technologies can still be evolved? What can we still do to make better commodities investing, to make the experience more pleasant?
I would suggest that, it's entirely possible while VanEck has an index fund, and we both agree that CMCI has really an awful lot of positive attributes. There's a possibility, at least on a fund level, for asset managers to create a product that's benchmarked to the CMCI, but may be able to change exposure relative to the index under certain conditions. And of course, somebody like VanEck, who has has really a great depth of resource and analytic capability in those markets, might be able to use that information to have an enhanced CMCI-based product. I really think that's the next step.
Yeah, I would agree with John. It's moving to the active management sphere with the indexes, and we are exploring those possibilities. And I think that would be the next step would be to add an element of active management to an index like CMCI, where you can overweight or underweight certain sectors depending on some fundamental analysis. But that gets away from the passive index approach and gets you back towards the active management side.
Okay. Well, chaps, thanks very much. I think this concludes our expert webinar on a better way to get commodity market exposure. I would like to thank Alan, John, and Roland for being my guests, and I'd like to thank the audience for listening and also for their questions. Just to remind you all that all the slides and the webinar will be available on our site in the next 24 to 48 hours. And that leaves me just to say thank you from myself and Index Universe, Bloomberg Indexes,